Hey everyone, welcome back to Corporate Decoder. Today we're diving into Fortitude Life Insurance and Annuity Company's latest quarterly report. And trust me, reading this financial document is almost as thrilling as watching paint dry almost. Today we will find out if Fortitude Life Insurance and Annuity is making money, how they are managing their assets, and if there are any nasty surprises lurking beneath the surface. Before we begin, appreciate straight insights from corporate documents. Make sure you're subscribed. We also have a Discord community linked in the description. Let's get started. This report covers the financial quarter ending March 31, 2025. It's basically a snapshot of how the company performed during the first 3 months of the year. So who are we looking at? Fortitude Life Insurance and Annuity Company, or FLIAC, is based out of Jersey City, New Jersey. But here's a twist. They're not your typical publicly traded company. They're actually a wholly owned piece of Fortitude Group Holdings, LLC. As of May 9, 2025, there were only 25,000 shares of stock outstanding, and Fortitude Group Holdings owns all of them. So this report is more for the regulators and bondholders than the general public. Keep in mind that, like all companies, Flex Report has a forward-looking statement section, which contains management's expectations and beliefs about future developments. This includes ongoing impacts from the global economy, risks of investment losses, potential insurance losses, changes in interest rates, liquidity needs, etc. These statements are not guarantees, and actual results could vary greatly. Navigating this report, here's what we will go over: their financial statements, what management has to say about their operations, quantitative data about market risks, and an overview of internal financial controls. Let's dive into the numbers, starting with the balance sheet. This shows what the company owns assets and what it owes liabilities at a specific point in time. FLIAC's biggest asset is fixed maturity securities with $5.1 billion. These are investments like bonds which provide a steady income stream. They also have $343 million in mortgage loans, and their total investments add up to $5.765 billion. Now for liquidity, they're holding a healthy $683 million in cash and cash equivalents. On the liability side, insurance liabilities, which is money set aside to pay claims, is at $4.64 billion. They also have liabilities associated with secured borrowing arrangements around $1.04 billion. Finally, the total equity, or the owner's stake in the company, is $123 billion. Moving on to their income statement, which reveals how profitable AFAC was over the 3 months. Comprehensive income amounts to $14 million. Premiums, the money they take in from insurance policies, are at $7 million, but policy charges and fee income are substantially higher at $107 million. Their investments also generated $65 million in net income, and there was $22 million in management fees. A major contributor was investment gains, netting $122 million. However, they had to set aside $359 million for policyholder benefits and changes in the value of insurance liabilities, along with operating costs and commissions, leading to a net loss before taxes of $28 million. After taxes, the net loss comes out to $24 million. Looking at cash flows is also important. Cash from operating activities was $355 million, which is offset by net cash used in financing activities, primarily related to repurchase agreements of $233 million. Essentially, they're borrowing and lending out money and securities. A section of the filing mentions this collateral transferred under these agreements is important, so keep an eye on that. Now, some nitty-gritty details about the accounting methods they use. They have elected something called the fair value option for many of their assets and liabilities. This simply means they are valuing many things at market price, which is very volatile but also very reflective of their real value. Also, new accounting standards were adopted in 2025 regarding segment reporting, which expanded how they disclose information about their different business areas. FLIAC basically operates 2 segments. One is called the retained business, which involves actively managing annuity products. Then there is the seeded business, which represents annuities that are fully managed by Prudential. As of March 31, 2025, the retained business held about $4.1 billion in investments compared to $1.7 billion in the seeded business. It's also important to note that the retained business segment is where all of the action happens, holding most of the assets and liabilities, while the seeded business segment operates more as a financial arrangement with another entity, Prudential. A key part of understanding their financial picture is how they value their assets and liabilities. They use a fair value hierarchy, which is just a fancy way of saying they prioritize using real-world prices over estimates when figuring out what things are worth. The tables break down their assets and liabilities into 3 levels, according to how they are valued. Level 1 is most reliable, using actual market prices, while level 3 involves more of their own assumptions and estimates. Fixed maturity securities like bonds are mostly valued using level 2 inputs. These are things that are observed in the market for the full term of the security. Mortgage loans, on the other hand, require estimates, so they are marked as level 3. Changes in the company's own credit rating related to insurance liabilities get recognized in other comprehensive income, which is separate from the main income statement. Level 3 assets and liabilities are a bit more opaque because their value are based on internal pricing and not easily observable. There was a lot of movement in and out of level 3 assets. As of March 31, 2025, most level 3 assets that the filing mentions are fixed maturities and mortgage loans, which is also where all the volatility is happening. And this section goes deep into accounting specifics, but for the general viewer, it's enough to understand that things depend a lot on internal estimates, especially when observable data is missing. Here's what FLIKE is invested in. Other invested assets include things like private equity, real estate, and derivative instruments. Looking at income taxes, there's a $50 million valuation allowance on deferred tax assets, meaning they might not be able to use all their past losses to reduce future taxes. There wasn't a dividend to the parent this time, but they approved one in early 2024. The company is committed to purchasing $855 million of fixed maturity securities and alternative investments. It's worth noting they have many lawsuits and legal claims, which they estimate is currently immaterial. All of this is common for a company of this size, so nothing major to be concerned about here. A significant portion of Fortitude's expenses stem from allocations or expenses charged by its parent company, FGH. A chunk of FLIKE's assets are under management by affiliates of the Carlyle Group. Carlyle also holds a sizable chunk of FLIKE's parent company, creating a web of financial relationships. All of this might lead to conflicts of interest with how much value it provides FA or lack thereof. The majority of level 3 assets have the same valuation assumptions from the company as their insurance liabilities. They have access to about $300 million through a liquidity agreement with their parent company, as well as a line of credit of up to $500 million. The maximum limit for the letter of credit is capped at $1.5 billion for all participants in the program. Here is management's take on all of this. Key factors influencing their results include movements in interest rates and equity markets, which drive investment income and can impact insurance liability reserves. FLIAC also relies on a risk-based capital ratio, RBC, to measure capital. FLIAC CEO and CFO believe their internal controls and procedures for financial reporting are effective. So what's the story after decoding all this corporate jargon? FLIAC appears to be in a period of adjustment with a focus on managing its existing business rather than expanding. The company is dependent on its parent and other affiliates for operational and investment management, which could present inherent risks. Key opportunities for FLIAC include effectively managing interest rate and equity market exposures and potential for the existing insurance product to produce high profits. However, they are also heavily exposed to these risks, which could impact regulatory capital levels. Overall, FLIAC is in an okay but not amazing position. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.